India development debate right here on ET Now. I'm Supriya Srinath, and with me here is my colleague and co-anchor Sandeep Gurumurthy. Straight on to a big debate tonight then. Status quo on rates and the policy stance. That's the sum and substance of the bi-monthly monetary policy review. After a two-day meeting of the panel, the RBI announced a status quo in the benchmark repo rate at 6%, even as it retained the neutral stance. While nobody was expecting a rate cut, quite frankly, Governor Urjit Patel justified the neutral stance, stating that nothing has changed since October, when the policy review was done last, and keeping in mind the output gap dynamics. The target for gross value added, or GVA, for the current fiscal has been retained at 6.7%, but the GVA growth for the last 2 quarters of this fiscal is pegged at 7 and 7.8% respectively.
There's a word of caution against the government's bank recapitalization plan, which the RBI fears could lead to fiscal slippage. Expressing concerns over rising prices, the MPC has upped the inflation target for Q3. The MPC may have played to the script, but we at ET Now believe it's time for some tough questions. Isn't it time the MPC gave growth a chance, moving away from a textbook approach on inflation? How can the panel justify the status quo on both rates and policy stance when by its own admission the Q2 growth was below expectations? More importantly, are signals from Mint Street any indication that the interest rate cycle has indeed bottomed out? Debating that is a very special panel on the show this evening. Joining us, we've got Mr. R. Gandhi, former Deputy Governor of the RBI, Dr. Arvind Virmani, President Forum for Strategic Initiative and a noted economist, Sunil Khan Munjal, Chairman, Hero Corporate Services, and Maithili Busturmat, Consulting Editor at ET Now. Mr. Munjal, I'm going to start off with you because it's been industry that's been, clamoring for a rate cut for months in a row now, and again, it's not coming through. Are you disappointed? Do you believe there was scope for an interest rate cut even in this policy of the central bank?
I certainly think there was scope to cut the interest rate this time, as there was in last time as well, because we've seen consistently the RBI has overestimated inflation. Inflation has remained benign now consistently for a long period of time, and industry needs this rate cut to help in the consumption cycle to pick up. There's a virtuous cycle we are all hoping will kick in by itself, but it does need support at this time. Fortunately, the government spending on infrastructure has gone up, but it would have been a great help if interest rate as a signal was also passed down, because what is going to happen now is private sector lenders are also going to have a problem, because with the rates going up in the market, their cost of funding is going to go up, and we don't see any chance of reduction of cost of funding in the short term, either for consumption, for housing, for industry, etc. So it is disappointing. You're right. Yes.
All right, a fair point indeed. There was scope for a rate cut, just like it was the last time around, says Sunil Khan Munjal, one of the most credible voices of Indian industry. But Dr. Virmani, let me throw this to you. The scope for a rate cut compared to last time, I'm presuming, has considerably reduced, and which is why the question, has the RBI put itself in its own trap? I mean, last time around in October, the inflation was at 3.28%. That has gone up to 3.58%. Growth was at 5.7%. The RBI did not relent on rates. Today, growth has gone up to 6.3%. Oil on an average for that month was at $57 a barrel. Today, oil is trading at $63 a barrel. So has the RBI been caught in its own trap, and which is why it hasn't been able to act on rate last time and also this time?
Okay, your statement was not quite clear, but let me try and answer it. The RBI seems to think it's like the Federal Reserve of the USA, which is kind of running the whole world. They don't want to fluctuate their repo rates too much. So the problem is they are constantly thinking of the longer and longer term future and refuse to change it. That change, you can go down and come up. There's nothing, it's not a philosophical or a moral thing. So basic mistake in my view, which the RBI has done, and which I could see even 2 years ago when I was participating to some extent in these discussions, is that you can, if the inflation and GDP is going the wrong way for 6 months, for 12 months, and if there are risk factors which are temporary, uncertainties, etc., you can lower the rate for 6 months and raise it again. So, but there has been this concept that if you have to raise the rate again 6 months later or 12 months, you must not lower it. And I think that's basically conceptually a wrong thing for a emerging market economy central bank to have. So, the question now is that if they didn't raise it last time around, or sorry, lower it or ease the monetary policy, clearly I can see from their point of view it becomes more difficult to do it now, because there's nothing pointing to the direction of reducing rates. So, what you're doing is you're basically sustaining the losses in GDP which have been there for 12-18 months so far, and one didn't expect them to act otherwise, as long as they have this philosophy that it's somehow I don't know, immoral or wrong to reduce a rate for 3 months, 6 months and then raise it again. So, as long as that philosophy is there, I am afraid we are going to have to put up with this these losses in GDP. I mean, one can argue how much these are, but I am pretty sure there are losses.
Mr. Gandhi, come in on that, and I reckon you'd probably be a little more sympathetic towards the central bank than Dr. Virmani and Mr. Munjal here are being. But the broader question is, what is so sacrosanct about 10 basis points? You know, this whole inflation targeting from 3.6 to 3.7, a range of 4.6 to 4.7. What is so sacrosanct about 10 basis points, especially since RBI's inflation reading has been consistently wrong, like Mr. Munjal pointed out as well, and as a result, they haven't sort of moved as aggressively on rates as people would have liked them to be. Isn't it more important, do you think, for the central bank to focus on a range than on a specific number? And the range is 2 to 6%. Shouldn't they focus on the range instead of focusing on a number up to the decimal point, which is what they seem to be doing?
Say, RBI has been looking at the inflation and growth scenario 6 months, 1 year forward, whereas most of the comments industry and others make is based on today's data. Today the inflation has been down, that is definitely seen, but RBI has foreseen it 6 months before. That is why in August, last August, it reduced the rate. So, by today RBI is seeing inflation will be trending up in the rest of the year. So, when the inflation is going expected to go up without any rate cut, with the rate cut it will be going up further. So, that is why RBI is hesitant to change the rate at this point in time. So, that's the way we have to look at it. So, RBI has consistently been looking at only the forward looking. So, whether it should look at a range or a point in time, either a range or a point, that is a question you asked. So, RBI always looks at the range also. Even in today's statement also, it has said that inflation is expected to range between about 4.3 to 4.7, and so that way it is looking at the range. It is not a pinpointed position that it should be 4.5 or 4. Only a medium term outlook has been kept as to reach closer to 4. That is prescribed by the law.
Mr. Gandhi, I have to respectfully say that I completely disagree with you there, and I will tell you why. If they have to look at a range, then the range is from 2 to 6%. The range is not 4 to 4.3 to 4.6 to 4.7%. I'm going to take this across to Maithili Busnoor, but Maithili, you know, Mr. Gandhi makes the point that RBI does inflation forecasting, or RBI has to do policy management for the entire year, and for the entire year, we may end up at levels above RBI's comfort zone of 4%. But the reality is, there are two questions there. Has the RBI missed the bus on a rate cut previously, and which is why we now have to live with this reality that its hands are bound, it cannot do anything going forward? And the second question, why are we talking about 4%? Why are we not talking about 2 to 6%? What happened to flexible inflation targeting? I mean, that's really the question. I'm going to actually, I think the line is down with Maithili, and if I can take this across to Mr. Munjal. And Mr. Munjal, you know, the flexible inflation targeting is what the whole idea of inflation targeting was. And I think a lot of people erroneously out there believe it's 4%. Actually, the reality is from 2 to 6%. Do you agree with me?
Yeah, that's the point I was trying to make, that we've actually seen over a period of time, it has remained well within a range-bound number which is acceptable to industry, government, the regulator, Reserve Bank, all of them seem satisfied and happy with this number. Why then is there not signaling to say, this is the direction we want to go? We will lower, because the RBI did make the statement, by the way, if you remember some months ago, that this is the direction we are going in now, but then they just stopped. And I don't think it's important. Psychological signaling for an economy in a difficult time, when the domestic market is going through a difficult time and the global markets are going through a difficult time, it is very, very important to provide the right signals at all the places. And if the RBI can lower interest rate every 2 months, they can also raise them if they find it's getting a little bit out of hand. They always have that lever is available to them. So to stick to doggedly to one number, I think is actually at this moment appears to be doing more harm than otherwise. And by the way, I have to give full marks to RBI for being consistent. They've stuck to their own plan, which is fine. But I think there is a need to recognize that industry, especially small industry, is suffering right now. The financing industry is suffering right now. And we do need the consumption cycle to kick back in for the spare capacity which appears to be now underutilized to get consumed, so that the people can get back into the investment cycle on the capex investment cycle and pull us back into a virtuous growth cycle, which we need at this moment.
Maitri, do you believe it's time to dump this textbook approach to inflation targeting? I know you've been very critical of inflation targeting framework to start with from the time it was conceptualized, but given the fact that we're living with this reality, is it then at least more important that we be a little more flexible and give up on this textbook approach to inflation targeting, which is holding growth back?
Oh, well, absolutely. I couldn't agree with you more, because the whole idea, in fact, I think right from the beginning, when we moved to the new monetary policy framework, we recognize that India is quite different from many other countries which had adopted a very strict inflation target. And so that was the idea of having a flexible inflation target. Unfortunately, the MPC and the RBI within that, in fact, I'd blame the RBI even more, because the composition of the MPC is such that the 3 members from the RBI, along with the governor's casting vote, basically can swing the decision. And the idea was that you need to have a flexible inflation target. Unfortunately, the MPC and the RBI, as I said, have always interpreted it as a very inflexible target. They're really fixated on that 4%, so they're not willing to give growth a chance. Today, in fact, their options are very limited. Their elbow room, their flexibility is very limited, because we are living in a globalized world where the Fed, which is virtually the de facto central bank for the entire world, is all set to hike interest rates, reduce the size of its balance sheet. So today, RBI has very few options left, but they could about 6 months ago, 8 months ago, when, as Supriya pointed out, it was very clear that they could have cut rates. At that time, they hesitated. And now today, it's much too late. We've missed the bus. And as one of the former TAC members and now member of the Prime Minister's Economic Advisory Council, Ashima Goel, has pointed out, there has been a real cost in terms of output lost. And I really wonder whether there will be anybody who calls the MPC or the governor to task and explain what do we do to make up for that lost output.
I wonder that too, Maithili, and I wonder that very much. But Dr. Virmani, I want to ask you this question, the point that Maithili made, that has RBI missed the bus, and who's going to compensate us for the time that the RBI has lost? I mean, I know we can turn around and say that in hindsight, everything is 2020, and hindsight is 2020. But, you know, the fact that RBI consistently read the data wrong and then did not relent on rate cut, who is going to be responsible for that? Where does the buck on that stop?
It clearly stops with the MPC. You know, I got tired of pointing to their over prediction of the inflation rate, and I've stopped doing it for the last 2-3 months. But the point is twofold. One is that one of the suggestions which has been made is that perhaps MPC should at least once a year, I would think, go before Parliament and at least try to justify what they have done over the year. You know, the tradition in the RBI is that the governor doesn't want to, and I've seen this for many years under many different governors, they don't want to be subject to Parliament and will resist. But I think an alternative could be that the the number 2, the deputy governor, and the rest of the members of the MPC could go before Parliament and perhaps have to answer difficult questions once a year. So that is one solution to this accountability problem. I mean, Dr. Bhalla has suggested the governor should go twice a year. I don't think that's feasible, but what I am suggesting I think may be feasible, and we can consider it. The second point I want to make, which you have not discussed so far, is this whole liquidity issue. And I think there is this same kind of misunderstanding. I just heard the governor say, the deputy governor, that the short term liquidity is very good. The same problem arose about 12 to 18 months ago, where the short term liquidity doesn't translate into the long term. So I suspect what is happening is the higher real rates in India are attracting capital inflows, and they are over sterilizing them in the conventional way and creating higher real interest rates on the medium long end of the spectrum, which will again have negative consequences on GDP growth.
Fair point. I don't think it's just about GDP growth. I think I want to take the point that you made about the real rate of interest being high, and that's at 2%. The RBI's own comfort zone is 1.5%. How is the divergence going to be justified, Mr. Gandhi?
See, first of all, I wanted to react to the comment that you made that RBI had got the data wrong. It is absolutely incorrect, because RBI has seen that inflation will be coming down in these quarters. That has been foreseen 6 months before, 8 months before, and RBI has also foreseen now that inflation will be trending up in the rest of the year. The same way on the growth side also, RBI's forecast has been consistent, and it is not that RBI got the data wrong. Another thing, based on the forecast it had made, earlier it had cut the rates, and now because its forecast shows inflation trending up and the risk are also there, so it has hesitated. So I won't be able to accept the position that RBI had seen the data wrong. Your point about whether it should be a flexible targeting or point targeting, that's a matter of debate. But they consistently across the world, the inflation targeting has been taken as the point only. So as of now, it has declared, it has openly disclosed that we are targeting 4.5 by the end of the year. So we have to, if we want to move that to be changed, that's a completely different debate. Now, your latest question about real interest rate. Real interest rate, there has been no consistent position across the world. So there are differences in terms of measuring the real interest rate. There is no consensus view on that. So one can say that it is 1.25. Some can say that it is 0.75 only. So there is no conclusive position on what is the real interest rate. So that's why we have to go by the other parameters which the Reserve Bank has been doing. That's what I would say.
Fair enough. Maitri, you spoke about it earlier. Does the commentary indicate that they've shut the window on a rate cut? And if anything, the next rate action from the central bank could actually be a rate hike?
Well, it would seem so, certainly, because they have said that if the output gap, the dynamics changes, then in that case, the monetary policy stance will have to be reconsidered, rethought of. Now, the only way the output gap can change, the dynamics can change and should change is if the output gap narrows, and if that happens, there's only one thing that can follow from that. It have to be an interest rate hike. Add to that the fact that the Fed is almost certain to hike interest rates when it meets next time, and also that we're going to have a new Fed chief who we really do not know how he will react, and the fact that the balance sheet of the Fed is bound to come down because the Fed is stated to have said that we are going to reduce the size of our balance sheet. All over the world, in fact, the rate cycle has reversed. Most central banks are on now, if at all, a rate cuts are out, easy monetary policy is out. So the RBI's hands are in many ways tied. In fact, we've already seen the 10-year bond yield rise. We've seen rates rise across the world, in fact. So I think the RBI, a combination of factors, the conundrum is such that the RBI's hands are almost completely tied. 99% it will have to be either status quo or in all probability a rate hike. So as I said, as Supriya also said earlier, the RBI has dug itself into a hole, and now there are very few options left to it. Unfortunately, it has not addressed even the issues in the banking sphere, which it should have used as opportunity to address, and that I think is the unfortunate part.
Mr. Munjal, you spoke about the impact on the SMEs, which are obviously battling, for survival in several sectors. But, for industry at large, what this also means is industry needs to forget about any sort of counter-cyclical stimulus, because it's evident that the government is not looking at fiscal stimulus, and now there's no monetary stimulus that's going to come its way as well. So should industry now reconcile itself to the fact that there is no counter-cyclical stimulus that's going to come through?
So I was not talking about this as a false stimulus. This actually deserves to be lower, and to the point, I think I didn't get who I think Mr. Gandhi made the point about liquidity, and he's right. There is a lot of liquidity, by the way, in the bank, and he's also right that the Reserve Bank has been making many forward-looking statements, and they have been good. They have been accurate and correct on their statements. But considering what they are saying, this kind of interest rate is what people are saying is not justified. And especially in the condition we are in, we've had a difficult time with 2 or 3 massive structural changes taking place in the economy. They have impacted production, they have impacted consumption, and at this time of all, we actually need this to be in place to allow people to borrow more, to allow people to consume more, to allow people to produce more. Jobs are suffering, consumption is suffering. I think that there is a need for us to look at this holistically. Because inflation cannot be taken out of context with everything else that's going on around us.
No, absolutely. But if I may take the same point forward, and if I will, I'll take it across to Dr. Virmani. And Dr. Virmani, there was a time when a lot of us thought that RBI was being overly cautious about and perhaps hawkish about inflation. Some will turn around and say, is it being overly cautious about the fisc right now? At least the commentary, the kind of fiscal slippage that it mentions on account of, tepid revenues from GST and all of that. And then, of course, RBI says that fiscal slippage may be inflationary in nature. But the reality is that at capacity utilization levels at 70%, that's farthest from the truth, is it not?
So there are 2 counters. One is on the fiscal. Let's take the fiscal first. The fiscal deficit, I don't think will be exceeded, basically because the way the fisc is measured, I think the capital part of it, the disinvestment, is doing pretty well and can be stepped up to compensate that. That's one aspect. The second aspect is that globally growth is finally picking up, which is a positive, but there are no signs at all that an increase in global demand, particularly for example from the EU, is leading to an increase in inflation. And that's a point we have mentioned several times in the global and the Indian context, that because of this huge global excess capacity, this time the pressures on inflation have been very muted, and many central banks have misjudged it. I agree that it's not only the Indian central bank. Some people had pointed out over the last week or so, but some of us have been saying that there is this general global deflation and deflation in India, and you have to be a little more active. And this is where your point, which I kind of couldn't hear clearly, on the flexible monetary policy or the flexible targeting comes in. When global situations are so different from what was envisaged, say 10 years ago or something like that, a central bank should be able to take a little risk and be able to say, okay, I'll reverse my policy. And so it links to that particular point, this kind of fear and obsession that I cannot lower interest rates for 3 months or 6 months or even 9 months because I may have to reverse 12 months later, I think is inconsistent with a flexible inflation targeting approach.
Closing comments from our panelists. I'm going to get Mr. Gandhi to counter the point that you made, Dr. Virmani, and also add to the point on, do you believe that the concerns on the fisc are a little exaggerated? The red flag that the central bank has raised on the fiscal deficit is a little exaggerated, and would it be fair to say that the central bank is now going to be in a wait and watch mode up until the budget, and the budget is going to be the next trigger for any sort of policy action by the central bank? Mr. Gandhi?
See, please, as I mentioned, the Reserve Bank's action and the MPC's action will be based on its own forecast on inflation. Other parameters it will factor in, but the primary item that it will be looking at will be the inflation trajectory. Inflationary expectation is another major input the MPC and the Reserve Bank always keeps in mind. That by the latest survey, it shows that the households are expecting the inflation to firm up. So, the Reserve Bank's own projections also show that inflation is trending up. So, in such a scenario, to expect that Reserve Bank will cut the rates, that doesn't augur right. So, inflation targeting or flexible inflation targeting, that we also have to look at from the perspective that if there is had been hypothetically there is a rate cut or whatever, how the inflation will be showing off, that projection also the Reserve Bank does. And another thing which we have to say that monetary policy or central bank action will always have to be predictable. There should be certainty, there should be clarity about its position. Constantly changing the direction from cutting to neutral to increasing, that will be confusing the market as a whole. So, there has to be consistency in the direction. So, that is why direction changes central banks always take a time. It is not that just like that you can change the course from left to right and the center. So, that is not possible.
No, one also hopes that the RBI hadn't switched to neutral as quickly as it did. But yeah, your point very well received there. Maitri, let's quickly talk about growth. We've spoken a lot about inflation, but growth, it's keeping its growth levels intact at projections intact at 6.7%, the GVA. And the assumption is that we'll grow at 7.8% in Q4 and at 7% in Q3. Where is that cheer coming from? Is this just statistical balancing that the RBI is doing?
Yeah, I would think so, certainly, because they stuck to that 6.7%. So, you do an arithmetical exercise, and the fact that there is a bump up because of the very low base that we had in the fourth quarter of last year. Last year, fourth quarter was only 5.6%. So, in comparison to that, even the normal recovery that we're seeing now will give you a good, apparently good rate of 7.8%, when actually the recovery will be much more muted. Unfortunately, the RBI doesn't seem to be thinking that could we have a higher rate of growth if the RBI were to do more, because in fact, the governor at the press conference, he said credit growth has already picked up. Where is it? Still less than 10%. And if you want to stimulate demand, if you want to ensure that there's greater credit offtake, there are other means apart from interest rate. You can also do things on the risk weights. There are various macro-prudential norms that you could alter. Unfortunately, the RBI is not looking at any of those areas. If you were to reduce the risk weight on certain kinds of lending, that would perhaps give a bump up to some more credit offtake in those areas. Banks will be more willing to lend. Likewise, if you were to take a more nuanced view of bankruptcy, the IBC, the NCLT, and the kind of huge haircuts that banks are taking, maybe the banks will be more willing to lend. So, I think the RBI needs to look at monetary policy holistically, not only at interest rates, but also on the banking side, and that is where I think the RBI has been erring.
So Mr. Munjal, let's look at the big picture then. We've moved from 5.7 to 6.3 this quarter, and it's pretty evident that the central bank is going to be cautious, if not hawkish, as far as growth, pushing growth is concerned. And let's for a moment assume that the government is going to be also sort of fixated in not missing its fiscal deficit targets over the medium term. In that circumstance, is it evident that it's going to be a painful climb back as far as growth is concerned? It's not going to be, we're not going to look at a hockey stick growth, but we'll have to do the sort of hard work to get to claw back growth slowly, and 7% is about as much as we can do in the medium term?
So, if I take a step back and look at the medium and long term picture, I think we're in great shape. We're in the right direction. We're making all the right moves, whether it's refinancing banks or it's building and operating a bankruptcy code, or it's bringing in GST. We have done actually amazing stuff as a country, if you see in terms of policy work, and a lot of it also action on the ground. But the concern is for here, and I think you're making a relevant point. It's the here and now which is a concern, because for India, I think the medium and long term is not really a big issue. We will grow. We will grow better than we are growing today. That's quite apparent. But the climb back up from here to the 7 to the 8 and the 9% is what we need to concern ourselves about, I think, in the immediate future. And that is what I was talking about when I said we need to figure out a way to quickly support the growth. By the way, the early signs are there in many areas. So, to be fair to the system, in some industry verticals, and some parts of India, you can see consumption start to pick up. It's not across the board right now, and the expectation is we are still some months away, potentially even a year away from full consolidation and full growth. But the early signs are all there that we're in the right direction. The problem right now is a lot of people are saying, I do not have the capacity to wait until the full recovery of a year or so that it might take. My small business is suffering right now, and I'm not able to borrow because it's too expensive. And I'm not able to grow my business because consumption is not picked up enough. So we are caught in a bit of a quagmire right now.
Indeed, there are many, many headwinds as far as Indian businesses and what they face are concerned. Dr. Virmani, I think I'll have to wrap the show very quickly, but let you take this last question, and it has to do with this short-term pain that Mr. Munjal referred to, and he says medium and long-term, we are in for a joyride, but as far as the short term is concerned, that's where we are stuck in a quagmire, to quote him. But do you believe it's been worth it? Has the pain been worth it as far as the short term loss of growth is concerned?
Yeah. So very quickly, let me go through the three demand side drivers. One, the net imports, they had jumped up in the 2 quarters when we had 5.7% growth. They have adjusted down as predicted, as I had written in my analysis, and so I'm pretty optimistic on that front. Secondly, the consumption, what I had indicated was that it's been on an uptrend, but I find that the consumption numbers which have come in this quarter, which we just had previously, the consumption is still below that trend, which suggests to me that some of this SME confusion and the GST related SME confusion, especially through the trade, is having some still some negative effect on that, and I expect that to be cleared by the next quarter. And finally, where there was a positive surprise was on the fixed investment, the overall investment, where there has been a little faster than I expected recovery. So overall, I confirm that what I had said, that the second half of the year will be far superior to the first half. Now, but that's not good enough. That will maybe get us to between 6.75 and 7% at the outer edge, and therefore going to the longer term, we come back to the same thing, which we don't have time to discuss, but there are still reforms which we must continue to do besides cleaning up the GST.
Oh yes, long way to go before we put ourselves in the firm high growth trajectory. Dr. Virmani, Mr. Munjal, Mr. Gandhi, Ms. Maitri Busnurmat, thank you so much for joining us with your perspective. Really appreciate you all taking the time, joining us with your frank opinion on the RBI action, or should we say inaction, as far as monetary policy is concerned. Thanks so much for being with us on the India development debate. We'll take a short break here, but Supriya is going to tell us what's coming up on the other side.
Indeed, we get you all about Battleground Gujarat. We tell you all about the Times Now VMR poll, who's gaining and who's going to face a loss in Gujarat, is all that we come back and discuss with you with an expert panel of politicians who are joining us right after this very, very short break.